Well, Vinod, I was just reading your report and it suggested that FY23 listed company capex was up 21% on a YOY basis. What are the trends looking like for FY24 and which sectors contributed to that capex in FY23? And is that a theme that we are seeing in FY24 as well so far?
Yeah, hi. So see, if you look at the corporate capex cycle, it started somewhere in the earlier cycle. I mean, it started in 2003, ended somewhere in 2012, and the aggregate capex was around 6 trillion at that point in time. And for the last almost 10 years, it has languished around that 6 trillion, up and down a bit. And for the first time, we are seeing this breakout into a range which is above 7 trillion, 7.6, that's what we measured. And it's the usual suspects. I mean, we always maintain that unless you have a broad-based gross fixed capital formation or the capex cycle in the economy, the corporate capex won't pick up, because the ones which really drive capex are the heavy industries like utilities, energy, metals, now auto because of the new age investments. So a lot of these telecom, these sectors have traditionally been the heavy lifters within corporates. And we are seeing in 23, if you see the large drivers are these sectors. And I think this will continue in 24 also. And as we mentioned, the initial driver of capex was the government capex, and
Sure.
which roots, it roots through the infrastructure ordering for some of these infra companies, and the real estate development, which helps, the construction companies. So I think
Okay.
these will be the pockets which will benefit.
Vinod, while that point is taken, in the corporate capex that you're talking about, which is at an all-time high, how much of it is replacement capex and how much of it is actually discretionary capex? And what is the ratio that you're expecting of these two segments going into FY24 as well?
Yeah, so that's an excellent question, Ekta. And what we have observed is till about last year, our corporates were just about doing maintenance capex. So the ratio of capex to depreciation was just about slightly above 1. So now we're seeing it moving slightly ahead. I mean, so it's 1.6 times. So I think the corporates are moving away from just doing maintenance capex to some amount of discretionary capex. And I think going by past trends, what we saw in 2003 to 2008-10, I think this will only pick up from here on, as companies have not been investing. The sectors I talked about have been under-investing for so long, and that will pick up, so yeah.
All right. So in that case, if one has to, play this macro trend through micro stocks, how would you suggest one do that? Because what are the categories where you believe capex is still to pick up, and who would benefit from those capex cycles picking up in those categories?
Yeah, so Mangalam, overall, the capex cycle has just started to pick up. So, it's not really picked up to the extent, we are not even in the mid-cycle, I would say. It's just starting to, it has bottomed out and it started to rise. That's what we can read through our analysis. So obviously, all the capital goods, the infrastructure players, and now we have the whole defense story, and so all these sectors. And apart from that, you have the corporate releveraging cycle, which will help the erstwhile corporate banks, because we have been only talking about retail credit growth so far, and corporate releveraging hasn't really picked up. So the derivative of this capex cycle is obviously the corporate releveraging cycle, which will also help some of these banks which are strong in corporate lending.
Okay, so what, according to you, would the possible risks be to this capex upcycle that we are talking about?
Yeah, so one of the biggest risks, which actually over the last few months has been kind of dissipated, is basically the extreme environment where interest rates were rising quite significantly, I would say, and liquidity was getting sucked out. So that, I think, is peaking out significantly. India has already paused. Some of the other developed markets are also pausing. So I think that is one of the key, what you should say, risk which was evolving just about a few months ago. If the interest rates were to really spike significantly, then that would dampen the spirits for capital intense capex cycle. So I think that's abating. So that risk is behind us. But apart from that, I mean, some major, what you should say, recession in the developed markets, which right now doesn't seem to be the case, but was building up as a case. So these are some of the factors that, global slowdown, significant global slowdown, does have an impact on broad-based capex cycle.
Okay. That point is taken, what might happen in the global markets and a possible recession or a mild recession as well, how it would impact exports. But we are also going into election year. How much of a catalyst would that be for the capex cycle domestically? And secondly, you seem to be quite bullish on the real estate space, continuing its strong trend. So stock-wise, how would you play the real estate space?
So if you see our list of stocks, if you especially look at real estate, apart from the few names, I mean, there have been a significant run-up in some of the real estate names, but a way to play them is through the building material companies that we have named over there. So, and the credit growth. So mortgage credit, I mean, people have forgotten that in the earlier cycle, we used to talk about a massive mortgage market in India. A lot of stocks really re-rated during that time. So I think these are some of the pockets, building material, mortgage lending, and developers themselves. Some of them where they have seen significant run-up and value is still there. I think this is the way to play real estate cycle. I think real estate cycle is just picked up over the last year or so. And typically these cycles we have seen last much more than that.
All right. Thanks a lot, Vinod, for joining in and giving us your views